John A.G. reveals why the silver bull market is just getting started, and what he's saying should make every business owner extremely uncomfortable. Because right now, while most investors are celebrating recent gains and calling this rally overdone, John A.G. is looking at something entirely different. He's looking at factory floors that can't run without silver. He's looking at mine shafts that take 10 years to dig. He's looking at vault inventories that are quietly, steadily disappearing. And he's asking one question that nobody wants to answer. What happens when the world realizes there simply isn't enough to go around? The clock is ticking, the pressure is building, and the market has no idea what's coming next. Welcome, friends, to Economy Revelation. If you've been watching the markets long enough to remember when silver was still measured in single digits, when a handshake meant something in business, and when people actually read the fine print before signing, then you're in the right place. This channel exists for those who understand that real wealth isn't built on hype. It's built on understanding what others haven't figured out yet. Now, before we go further, do me a favor. You see that subscribe button? The one that probably looks smaller on your screen than it should? Go ahead and click it. Not because I need the numbers, but because what we discuss here doesn't get discussed anywhere else. Not like this, not with this level of detail. And leave a comment below. Tell me where you're watching from. Are you in Toronto, Mumbai, London, Sao Paulo? I want to know because this silver situation, it affects every corner of the global economy, your corner included. All right, let's get to work. John A.G. sat in his office in early 2025, looking at two charts that told completely different stories. The first chart showed silver's price. It had climbed significantly over the past several years. Sharp moves up, painful corrections down. The kind of volatility that makes casual investors nervous and financial advisors cautious. The second chart showed something else entirely. It showed industrial silver consumption. And unlike the price chart, this line moved in only one direction, up, steadily, relentlessly, without pause. John A.G. had spent 3 decades analyzing commodity markets. He had seen booms that ended in disaster. He had seen panics that led nowhere. He had learned to separate noise from signal, entertainment from information, speculation from structural change. And what he was seeing in silver, this wasn't speculation. This was structural change that most market participants were completely mispricing. The confusion was understandable. For years, silver had been treated as a secondary asset. It was gold's cheaper cousin. It was the metal people bought when they couldn't afford gold. It was volatile, unpredictable, and exhausting to own. But something had shifted beneath the surface, something that had nothing to do with investor sentiment or technical chart patterns. Silver had quietly become a critical industrial input for the technologies that were supposed to define the next 20 years. Every solar panel being installed across China, Europe, and North America required silver. Not a little, a meaningful amount. Between 15 and 20 grams per panel, depending on the technology. And the world wasn't installing a few thousand panels, it was installing hundreds of millions. Every electric vehicle rolling off production lines in Detroit, Shanghai, and Stuttgart contained silver components. The electrical systems, the charging infrastructure, the battery management systems, these weren't optional features. They were engineering requirements. Every 5G tower, every data center, every advanced medical device, every military radar system. Silver wasn't decorative. It wasn't symbolic. It was functional. And in most applications, there was no economically viable substitute. John A.G. pulled up the supply numbers. This was where the story became uncomfortable. Global silver mine production had been essentially flat for 5 years. Not growing, not shrinking, just flat. Around 830 million ounces per year, give or take. Meanwhile, industrial demand alone was consuming over 600 million ounces annually. And that number was rising, not by 1 or 2%, by 5, by 7, by 10% in some applications. The math was simple, brutal, unavoidable. The world was consuming silver faster than miners could pull it from the ground. And this wasn't a one-year anomaly. This was a trend that had been building since 2020 and was accelerating into 2025. John A.G. knew what happened in markets when consumption persistently exceeded production. He had seen it in copper during the China infrastructure boom. He had seen it in uranium after Fukushima. He had seen it in palladium when diesel emission standards tightened. First, inventories declined quietly, then they declined obviously. Then, procurement managers started panicking. Then, prices did things that looked irrational to people who weren't paying attention to the physical market. But here was the part that made John A.G.'s analysis different from the usual commodity bull story. This wasn't just about industrial demand. Investment demand was waking up too, slowly, inconsistently, but unmistakably. Central banks around the world had spent 2023 and 2024 buying gold at record levels, over 1,000 tons per year. The message was clear. Sovereign nations were diversifying away from purely fiat currency reserves. That psychology, that shift in institutional thinking, it didn't stop at gold. Silver had always been gold's more volatile, more industrial cousin. When gold moved, silver eventually followed. But it followed with leverage, with amplification, with a kind of price momentum that rewarded early positioning and punished hesitation. And now, in early 2025, both dynamics were in motion simultaneously. Industrial buyers who needed silver for manufacturing were competing with investment buyers who wanted silver for portfolio protection. Two types of demand, two different motivations, one relatively fixed supply. John A.G. had seen this setup before in other markets. It never ended calmly. The business community wasn't paying attention yet. Corporate procurement departments were still treating silver as a commodity they could source on demand. Financial advisors were still telling clients that silver was too volatile for serious portfolios. Mainstream analysts were still calling every rally a top. But John A.G. wasn't looking at sentiment. He was looking at the physical flows, the inventories, the delivery patterns, the mine development timelines, and everything he saw told him the same thing. This wasn't the end of a bull market. This was the beginning of something much larger. The pressure was building beneath the surface. The imbalance was widening. The timeline was compressing, and most people were still looking at the wrong chart. John A.G. had a phrase he used when explaining complex market dynamics to people who were new to commodity analysis. He called it the vice grip. It was what happened when two powerful forces squeezed an asset from opposite directions, and that asset had nowhere to go except up. In early 2025, silver was caught in exactly that kind of vice grip. On one side, industrial demand that didn't care about price. On the other side, investment demand that was just beginning to wake up. And in the middle, a supply system that couldn't respond quickly, even if it wanted to. Let's start with the industrial side, because this was the part most investors completely misunderstood. When people thought about commodity demand, they usually imagined it as elastic, meaning when prices rose, demand would fall. When prices fell, demand would increase. Supply and demand would find balance. Markets would stabilize. That logic worked for many commodities. It did not work for silver in 2025, because the industrial applications consuming silver weren't optional. They weren't discretionary. They weren't things manufacturers could simply decide not to do if silver got expensive. A solar panel manufacturer in Germany couldn't build panels without silver paste for the electrical contacts. The technology required it. There was no substitute that worked as well at any price point that made economic sense. An automotive engineer in Japan could not design electric vehicle charging systems without silver alloys for the high current electrical contacts. The conductivity requirements were non-negotiable. Copper couldn't handle it. Aluminum couldn't handle it. Only silver could handle it. A medical device company in Massachusetts couldn't produce advanced diagnostic equipment without silver components in the circuitry. The precision required silver's unique properties. This wasn't a preference. It was physics. John A.G. had studied the substitution question extensively. Because if industrial users could simply switch to something cheaper, then the whole thesis collapsed. But the research showed something striking. In most high-tech applications, silver was irreplaceable at current price levels. Even if silver doubled, tripled, quadrupled in price, it still represented such a small percentage of the final product cost that manufacturers would continue using it rather than redesign entire production systems. A solar panel might contain $20 worth of silver, but the panel sold for $300. If silver prices doubled, the manufacturer absorbed an extra $20 in cost. Annoying, but not catastrophic. Certainly not worth the engineering expense and time delay of switching to inferior alternatives. This was the part that made industrial demand so dangerous from a supply perspective. It was inelastic, predictable, growing. John A.G. pulled up the photovoltaic industry projections. The numbers were staggering. Global solar installations were expected to reach 500 gigawatts of new capacity in 2025, 600 gigawatts in 2026. The trajectory was steep because governments around the world had committed to renewable energy targets they legally couldn't back away from. Each gigawatt of solar capacity required approximately 30 tons of silver. Do the math. 500 gigawatts times 30 tons, 15,000 tons of silver. That was 150 million ounces, just for solar, just for 1 year. And that was before accounting for electric vehicles. John A.G. looked at the EV production forecasts. 20 million units in 2025, 25 million in 2026, 30 million by 2027. Each vehicle contained between 15 and 30 grams of silver, depending on the model. Call it an average of 20 grams to be conservative. 20 million vehicles times 20 grams. 400 tons. Another 13 million ounces annually and growing. Add in 5G infrastructure. Add in consumer electronics. Add in medical devices. Add in industrial automation. Add in military applications that governments never discussed publicly but consumed silver nonetheless. The baseline industrial demand was already above 600 million ounces per year. and it was accelerating towards 700 million ounces within 24 months. Now, here's where the vice grip tightened. Because industrial demand was only half the equation, investment demand was the other half. And investment demand moved differently. Industrial buyers purchased silver consistently, month after month, year after year. They needed it for production schedules that were planned quarters in advance. Investment buyers were different. They ignored silver for years. They forgot it existed. They dismissed it as too volatile, too speculative, too difficult to understand. And then something changed. A policy announcement, a currency crisis, a geopolitical shock, a technical breakout on the charts. And suddenly, everyone remembered silver existed. John A.G. had watched this pattern repeat across multiple cycles. The investment community didn't move into silver gradually. It moved in waves, surges, stampedes. And in early 2025, the conditions for that kind of wave were building. Central banks had been buying gold aggressively for 2 years. Over 1,000 tons in 2023, over 1,000 tons again in 2024. China, Russia, India, Turkey, Poland. The list of buyers kept expanding. The message was unmistakable. Sovereign institutions were diversifying reserves away from pure dollar dependency. But here was the interesting part. Gold was expensive, over $2,000 per ounce. Politically complicated to accumulate in large quantities without moving markets. Difficult to transport, difficult to store securely. Silver was different, cheaper per ounce, more abundant in available supply, easier to accumulate quietly. John A.G. wasn't suggesting central banks would suddenly start hoarding silver the way they hoarded gold. That wasn't the point. The point was that the same psychology driving central banks toward gold, that same concern about fiat currency stability, that same desire for tangible reserve assets, it filtered down into institutional investment strategies. Pension funds, sovereign wealth funds, family offices, high net worth individuals. These entities didn't need to buy silver because they loved the metal. They bought it because their risk models told them that monetary policy uncertainty required portfolio diversification beyond traditional paper assets. And when that investment wave started moving, it moved fast. John A.G. pulled up the ETF flow data. Silver ETFs had seen modest inflows through 2024. Nothing dramatic, a few million ounces here and there. But the pattern was familiar. Modest inflows were how every major investment wave started. Quiet accumulation by early movers who understood the setup before it became obvious. Then came the technical breakout, the headlines, the CNBC segments, the Reddit threads, the YouTube videos with titles like Silver to the Moon. And then the real volume arrived. John A.G. had watched this exact sequence during the 2010-2011 silver surge. Quiet accumulation for months, then an explosive move that took silver from $18 to $48 in less than a year. That move had been driven primarily by investment demand. Industrial fundamentals were supportive, but not extraordinary. It was pure momentum, pure speculation, pure fear of missing out. And it had ended badly, because moves driven purely by investment psychology always ended badly. The fundamentals couldn't support the price. Leveraged positions unwound. Margin calls cascaded. Silver collapsed back below $30 within weeks. But 2025 was different. This time, industrial demand was already consuming more silver than mines could produce. This time, the supply deficit was structural, not temporary. This time, if investment demand surged the way it had in 2011, there was no inventory cushion to absorb it. John A.G. stared at his screens. Two forces, two entirely different drivers, both pointing in the same direction. Industrial buyers who needed silver and couldn't stop buying. Investment buyers who wanted silver and were just starting to buy. One supply system that couldn't expand quickly enough to satisfy both. The vice grip was tightening, and nobody, absolutely nobody, was prepared for what happened when that grip closed completely. John A.G. had learned something important during his decades analyzing commodity markets. The number on the screen, the price you saw flashing on your computer monitor, that wasn't always the real price. It was the paper price, the derivative price. The price people agreed to pay for contracts that represented silver, but weren't actually silver. The real price, the one that mattered when factories needed metal and vaults were running low. That price lived somewhere else entirely. It lived in the physical market. And in early 2025, the physical market was telling a very different story than the paper market. John A.G. started where every serious commodity analysis had to start, with supply. Because supply wasn't abstract. It wasn't theoretical. It was geology, engineering, capital, time, and all four of those factors were working against silver production in ways most investors never bothered to understand. Let's begin with the geology. Silver didn't come out of the ground the way most people imagined. There wasn't a silver mine where workers showed up, dug holes, and pulled out pure silver. No, that wasn't how it worked. Approximately 70% of global silver production came as a byproduct, meaning it came from mines that were primarily digging for something else: lead, zinc, copper, gold. The miners weren't making decisions based on silver prices. They were making decisions based on the primary metal. If copper prices justified running the operation, they ran it. If copper prices didn't justify it, they shut it down. The silver that came along was secondary, a bonus, not the main event. This created a bizarre dynamic. Even when silver prices rose dramatically, even when silver became more valuable, production didn't necessarily increase, because the mines producing silver weren't responding to silver economics. They were responding to base metal economics. John A.G. had seen this dynamic play out in 2020 and 2021. Silver prices had surged, but production had actually declined slightly because COVID disruptions and lower copper prices had shut down operations across South America. The market had assumed higher silver prices would bring more supply. The market had been wrong. Now add the second problem: grade decline. The average grade of silver ore being mined in 2025 was significantly lower than it had been a decade earlier, meaning miners had to move more rock, process more material, and consume more energy to produce the same amount of silver. This wasn't speculation. This was documented data from mining company reports across Mexico, Peru, Chile, and Australia. The easy, high-grade deposits had been mined already. What remained required more capital, more time, and more operational complexity to extract. John A.G. looked at the development timeline for new silver projects. This was where the supply story became truly problematic. From discovery to production, a new mine took between 7 and 12 years to develop. 7 to 12 years. That included exploration, permitting, environmental studies, infrastructure construction, financing, and commissioning. Even if a mining company discovered a world-class silver deposit tomorrow, even if they had unlimited capital and regulatory approval, that mine wouldn't produce meaningful silver until 2032 at the earliest. The supply response time was measured in years, nearly a decade. But industrial demand was growing right now. Investment demand could surge next quarter. The mismatch was structural, and it was getting worse. John A.G. shifted his attention to the physical market architecture, because this was where theory met reality, where paper promises confronted physical delivery. The global silver market operated through several key hubs: the COMEX in New York, the London Bullion Market, the Shanghai Gold Exchange. Each of these venues maintained inventories, vaults full of physical silver that backed the paper contracts being traded electronically. In theory, the system worked smoothly. Traders bought and sold contracts. Most positions were closed financially without ever touching physical metal. The inventories sat quietly in vaults, providing confidence that delivery could occur if needed. In practice, the system had pressure points. John A.G. pulled up the COMEX registered inventory data. Registered inventory was silver that was actually available for delivery against futures contracts. The number had been declining steadily since 2023. Not crashing, not collapsing, just declining, month after month, slowly, persistently, from over 120 million ounces in early 2023. Down to under 70 million ounces by early 2025. That 70 million ounces sounded like a lot, until you did the math. Global industrial demand alone was consuming over 600 million ounces per year. That meant COMEX registered inventory represented roughly 42 days of global industrial consumption. 42 days, 6 weeks. That wasn't a comfortable buffer. That was a thin margin. Dangerously thin, if anything, disrupted the normal flow of metal through the system. John A.G. had studied previous commodity squeezes. Nickel in 2022, palladium in 2020, cocoa in 2024. They all followed similar patterns. Inventories declined gradually. Market participants dismissed the decline as normal. Then something unexpected happened. A supply disruption, a surge in demand, a technical default somewhere in the delivery chain. And suddenly, the paper price and the physical price diverged violently. Buyers who owned paper contracts discovered they couldn't actually get physical metal at the screen price. They had to pay premiums, large premiums. Premiums that turned into panic. The London market showed similar patterns. Vault inventories had been relatively stable through 2024, but showed concerning withdrawal patterns in recent months. Shanghai was different. The Shanghai Gold Exchange operated on a physical delivery model. Every contract required physical settlement. No cash settlement, no rolling positions, indefinitely, and Shanghai premiums. The amount Chinese buyers paid above the international spot price had been widening, not every day, not consistently, but the trend was unmistakable. When Chinese buyers wanted physical silver, they were paying more than the international screen price suggested they should pay. That premium was information. It was the market saying that physical metal in the right location at the right time was worth more than the generic contract price implied. John A.G. knew what professional traders called this phenomenon: backwardation, the condition where near-term physical delivery was more valuable than future delivery promises. Backwardation in industrial commodities was unusual. It suggested immediate supply tightness. It suggested that someone, somewhere, needed metal right now and couldn't wait. Silver had shown brief periods of backwardation multiple times since 2020. Each time the market dismissed it as temporary. Each time it resolved. Each time prices moved higher afterward, but the frequency was increasing. The duration was lengthening. The divergence between paper and physical was widening. John A.G. pulled up his notes on derivatives positioning. This was the shadow layer of the market, the part most people never saw. The paper-silver market was enormous. Hundreds of millions of ounces traded daily through futures, options, and OTC derivatives. But the physical silver backing all that paper, that was much smaller. Estimates varied, but most analysts believed the paper-to-physical ratio was somewhere between 100 to 1 and 200 to 1. Meaning, for every physical ounce of silver actually sitting in a vault, there were 100 to 200 ounces worth of paper claims against that metal. In normal times, this wasn't a problem. Most paper positions closed financially. Most traders never wanted physical delivery. The system functioned smoothly because everyone trusted that physical delivery was available if needed, so nobody actually needed it. But trust-based systems had breaking points. John A.G. had watched the nickel market break in 2022. Prices had exploded from $30,000 per ton to over $100,000 per ton in less than 48 hours. Trading had been suspended. Positions had been forcibly closed. The entire market structure had temporarily collapsed because too many people wanted physical delivery simultaneously, and there was not enough physical nickel available. Silver hadn't broken yet, but the conditions were aligning. Industrial demand pulling metal out of vaults for manufacturing. Investment demand potentially pulling metal into ETFs and allocated storage. Mine production unable to increase quickly enough to refill what was being withdrawn. And underneath it all, a massive paper market built on the assumption that physical delivery would never actually be demanded at scale. John A.G. stared at his inventory charts. The lines were declining, slowly, steadily, undeniably. Markets could ignore declining inventories for a long time, right up until they couldn't. And when that moment arrived, when the market suddenly realized there wasn't enough physical metal to satisfy both industrial need and investment demand, the paper price would become irrelevant. The only price that would matter was the price someone would pay for metal they could actually touch. And that price, nobody knew where that price would end up. John A.G. had watched countless investors make the same mistake during commodity bull markets. They understood the thesis. They believed in the fundamentals. They recognized the supply-demand imbalance. And then they positioned themselves in exactly the wrong way. They bought the metal itself, physical silver, coins, bars, ETFs tracking spot prices. Nothing wrong with that approach. It was safe. It was tangible. It was straightforward. But it missed the leverage because in every major commodity bull market, the real wealth transfer didn't happen in the commodity itself. It happened in the companies that produced the commodity, the miners. John A.G. had studied the 2003 to 2011 gold and silver cycle extensively. During that period, gold rose from approximately $300 per ounce to nearly $1,900, a six-fold increase, life-changing if you bought at the bottom. But the mining companies, the producers, they didn't rise six-fold. Some rose 10-fold, 20-fold, 50-fold. The best-performing silver miners during the 2009 to 2011 surge delivered returns that made the metal's price movement look modest by comparison. Why? Because of operational leverage. Let John A.G. explain how this worked, because most investors never fully grasped the mechanism. Imagine a silver mining company that produced silver at an all-in cost of $20 per ounce. That included extraction, processing, administration, capital expenditures, everything. When silver traded at $25 per ounce, that company made $5 profit per ounce. Not bad, but not spectacular. Now imagine silver rose to $35 per ounce, just a 40% increase in the metal price. But the company's costs didn't rise 40%. Costs were relatively fixed in the short term. Maybe they rose 10 or 15% due to energy and labor inflation. So now the company was producing at $22 per ounce and selling at $35 per ounce, $13 profit per ounce. The metal price rose 40%, but the company's profit per ounce rose 160%. That was operational leverage, and it flowed directly into cash flow, balance sheets, and eventually stock prices. But here was the critical part that separated successful resource investors from failed ones. Not all miners were created equal. John A.G. had developed a framework for evaluating silver mining companies. It wasn't complicated, but it required discipline. First criteria, balance sheet strength. Mining was capital intensive, equipment broke, permits expired, ore bodies depleted. Companies needed cash reserves or access to capital to handle operational surprises. During the early stages of a commodity bull market, the companies with clean balance sheets survived. The companies buried in debt, they got acquired cheaply or went bankrupt despite rising metal prices. John A.G. always screened for debt-to-equity ratios first. If a company was over-leveraged, it didn't matter how good the deposit was. Financial distress would prevent shareholders from capturing the upside. Second criteria, production growth profile. A company producing 10 million ounces per year with no ability to expand was as valuable as a company producing 5 million ounces per year but developing projects that could double production within 36 months. Growth mattered, because institutional investors buying mining stocks weren't buying static businesses. They were buying future cash flow expansion. Third criteria, jurisdictional risk. A silver mine in Nevada was not the same as a silver mine in a country with unstable governments, unclear property rights, or a history of nationalizing natural resources. John A.G. had watched investors get seduced by impressive geological reports from projects in problematic jurisdictions. The deposits looked amazing on paper. The economics looked fantastic. And then a new government got elected. Royalty rates doubled. Export restrictions appeared. Mining licenses got suspended pending environmental reviews that never concluded. Geography mattered. Stability mattered. Rule of law mattered. Fourth criteria, management quality. This was harder to quantify, but just as important. Mining was operationally complex. Projects went over budget. Timelines slipped. Metallurgy proved more difficult than expected. Good management teams navigated these challenges. Poor management teams blamed external factors and burned through shareholder capital. John A.G.'s looked for management teams with track records. Had they built mines before? Had they delivered projects on time and on budget? Did they own significant equity in the company themselves? Skin in the game mattered. A CEO with $10 million of personal wealth tied up in company stock made different decisions than a hired manager with a salary and stock options. Now, here's where the opportunity and the danger intersected. As of early 2025, silver mining stocks were not priced for a sustained bull market. Most traded at valuations that implied silver would remain range-bound or decline. Price-to-net asset value ratios were compressed. Cash flow multiples were depressed. Market capitalizations were a fraction of what they'd been during previous bull cycles. This was the opportunity. But it came with psychological challenges that destroyed most investors before they could profit from being right. Because bull markets in volatile sectors didn't move in straight lines. They moved in violent, gut-wrenching waves that tested conviction repeatedly. John A.G. had lived through enough cycles to know the pattern. Phase 1, disbelief. Prices started rising, but market participants dismissed it as temporary. Mining stocks barely moved. Investors who bought early questioned whether they'd made a mistake. This phase was psychologically exhausting because nothing seemed to be working despite the fundamental thesis playing out. Phase 2, recognition. Institutional money started noticing, balance sheets improved, cash flow turned positive, analysts upgraded ratings, stock prices began reflecting operational leverage. This phase felt validating. Early buyers finally saw their positions move. Momentum built. Everything seemed obvious in retrospect. Phase 3, mania. Everyone became an expert. Retail investors piled in. Junior exploration companies with no production got valued like producers. Risk management disappeared. Valuations detached completely from fundamentals. This phase felt euphoric. Portfolios doubled in months. Every dip got bought aggressively. The idea that prices could fall seemed absurd. And then, the correction. Not a gentle pullback. A violent, nauseating collapse that erased months of gains in weeks. Over-leveraged positions got margin called. Weak hands sold in panic. The media declared the bull market dead. And yet, if the underlying fundamentals remained intact, the bull market wasn't dead. It was just resetting, shaking up the tourists, preparing for the next wave higher. John A.G.'s view in early 2025 was clear. Silver was in phase 1, transitioning toward phase 2. Early recognition was building, but mania was nowhere in sight. The opportunity was still early, not at the absolute bottom. And that moment had probably passed in 2020 or 2021, but early enough that substantial upside remained. The evidence was everywhere if you knew where to look. Industrial demand fundamentals were tightening faster than consensus expectations. Investment demand was awakening but hadn't gone parabolic yet. Mining stock valuations were still depressed relative to historical bull market levels. Physical market inventories were declining steadily. Delivery stress indicators were flashing yellow, not red, but moving in the wrong direction. John A.G. identified several catalysts that could accelerate the timeline. A major supply disruption at a significant mine. Political instability in a key producing region. A currency crisis that drove institutional investors toward hard assets. A technical breakout above a multi-year resistance level that triggered momentum algorithms. Any of these could compress what might normally take years into months. But even without dramatic catalysts, the structural pressure was building. Because at the end of the day, markets were just information systems that eventually priced reality. And the reality was simple. The world needed more silver than miners could currently produce. That gap was widening, and eventually, inevitably, the price would adjust to reflect that reality. The only questions were timing and magnitude. When would the market fully recognize what was already happening in the physical supply chains? How high would prices need to rise before new supply could meaningfully respond? How many investors would remain positioned through the volatility required to capture the move? John A.G. didn't pretend to know exact answers. Nobody did. Markets didn't move on schedules. But he understood the framework. He recognized the setup. He'd seen versions of this pattern in copper, uranium, palladium, and rare earths. Structural supply deficits didn't resolve quickly. They resolved expensively. And the investors who understood that, who positioned appropriately, who managed risk intelligently, who stayed disciplined through the psychological warfare of volatility, those investors didn't just survive commodity bull markets. They built generational wealth from them. Silver in 2025 wasn't a speculation. It wasn't a gamble on sentiment or technical patterns. It was a strategic response to structural imbalance that policymakers, manufacturers, and market participants were only beginning to acknowledge. John A.G. leaned back from his screens. The data was clear. The thesis was sound. The timing was uncertain, but the direction was not. The silver bull market wasn't ending. By every metric that mattered, by every framework he'd developed over 3 decades analyzing commodity cycles, it was just getting started. The only question now was whether investors would recognize it before the opportunity passed. Because markets didn't wait for consensus. They rewarded early understanding and punished late arrival. The clock was ticking. The fundamentals were screaming. And the next 12 to 24 months would separate those who understood what was happening from those who would spend years wishing they had.